Hello, and welcome to Taking Control of Your Finances, the seminar where we discuss a plan to reduce debt and build savings. Today, Americans are carrying a staggering $2.92 trillion on all types of consumer debt. Of that, revolving debt accounts for more than $845 billion. Each U.S. household carries an average of $15,112 in credit card debt. Yet in late 2008, in the wake of the financial meltdown, something extraordinary happened. Americans actually reduced their household debt by 3% and slowed their rate of spending. This was the first such decline recorded by the Federal Reserve since it began tracking consumer debt levels in 1952. While this decline is an encouraging sign that Americans may finally be taking their financial futures more seriously, there's clearly a very long way to go before we can safely say we're a nation of savers, not spenders. There's much work to do in each and every household to turn around the financial status of the American family. My goals here today are to help you assess your current debt load and spending habits and give you the tools to assemble a sound plan for successfully managing your debt. Those tools will include a personal balance sheet, a spending plan, and a monthly budget, all of which I'll help you develop. This Worksite Financial Solutions seminar is offered through your employer and your retirement plan advisor. Worksite Financial Solutions is a guidance-based, beginning-to-end retirement solution designed to help you create confidence in your financial life. The Worksite Suite offerings includes workplace education that's tailored to your unique needs and profile. It's also supported by a qualified LPL financial advisor who's committed to providing you with unified, coordinated advice. Whether you're joining the plan for the first time, accumulating assets, or seeking help with a career transition, Worksite Financial Solutions pulls all aspects of your finances into a single, manageable focus that will help you save time. In theory, using credit shows we have confidence in our future ability to pay. In practice, we often use credit for just the opposite, when we can't actually afford a purchase. One reason many people overuse credit is that they're living from paycheck to paycheck and have no cushion for emergencies. But in the long run, using credit as a cushion can lead to debt and undermine efforts to build saving for important goals. Amassing debt isn't difficult today. We're bombarded with advertisements for thousands of must-have products and inundated with credit offers, pre-approved credit cards, increased credit limits, and department store credit lines. What can get you into trouble is the inability to use credit wisely. Spiraling credit card debt often comes from impulse buying. But no matter what your income, you can dig yourself out of debt by spending less than you make. That may sound simple, but first you got to know exactly how much you're spending and find ways to cut back. For many people, the hard part is getting started. But you have a leg up. You're here today to learn to manage your money more effectively. We'll begin by analyzing your expenses and your spending habits. Then, we'll discuss how to use debt wisely. You'll learn how to create a budget to address both your debt and your spending needs, with an eye toward building savings for the future. And we'll show you how to reduce debt and stay out of financial trouble. After today's seminar, you should be prepared to change your financial situation for the better, perhaps in as little as 6 months. Let's begin by creating a personal balance sheet to itemize your debt as well as your liquid assets. Complete Worksheet 1 now. If you brought records of financial statements with you, feel free to use them. If you didn't, don't worry. Complete the worksheet as best you can from memory. If you have any questions, I'll be happy to help you. Total up your liquid assets, including any savings and investment accounts. Do not consider amounts in IRAs and other retirement plans. Calculate how much you need to cover a minimum of 3 months of living expenses, ideally 6, and subtract that amount from your assets. You'll want to give yourself this cushion in case of some unforeseen crisis, like losing your job or a medical emergency. Also, subtract any major purchases you expect to make in the next year. What remains, if anything, are your net assets, assets from which you could start to pay down your debt. Now list your debts in order of interest rate, from highest to lowest. How do things look? Debt comes in many forms, some quite useful and necessary. 40 years ago, your parents may have paid cash for their homes or their cars. Let's see a show of hands here. How many of you paid cash for your home or car? If you have a mortgage or an auto loan, you're carrying what's called installment debt, meaning you pay a portion of the total due at regular intervals over a given period of time. Installment debt helps us to get what we need when we need it. Similarly, school loans and small business loans can be a valuable investment in your future. Carrying credit card debt, on the other hand, is usually counterproductive. Let's take a closer look at those little plastic traps. Do you know the interest charged by each of your credit cards? The average APR on a new credit card offer is currently about 15.03%, but fierce competition forces some companies to offer a better deal. Yet, you may pay rates of 20% or more. Keep in mind that many credit card companies offer lower rates for an introductory period only. But if you can find a card with a reasonable rate and no catch, consider transferring your balances. Why pay 20% interest when you can pay 8% or 9%? Why pay annual fees? Many companies will waive them. How many cards do you carry? If you're carrying a balance on each card you have, you've got a better chance of losing track of your balances. Limiting the number of cards you use can help you keep tabs on your spending. We'll talk more later about how to eliminate extra cards. A recent change in banking regulations required higher minimum credit card payments from millions of American consumers. The idea behind the payment hike was not to hurt consumers. To the contrary, it was supposed to help consumers pay down their balances faster, with a greater percentage of their payment going to principal instead of interest. Generally, where credit cards previously required customers to pay off 2% of their outstanding balance each month, most now require customers to pay all monthly interest and fees and pay 1% of outstanding principal. The minimum payment is a fraction of your overall balance. Under the standard payment system, if you continued to pay only the minimum required, you would pay primarily interest on the debt, and you could stay buried in a never-ending cycle of payments, especially if you continue to use the card. The longer you carry a balance, the more total interest you'll pay. Assume you have two debts of $2,000 each. One is in the form of an installment loan with a fixed payment each month. The other on a credit card that charges a minimum monthly payment based on your balance. Both charge an interest rate of 18%. The first minimum monthly payment on the credit card would probably be 5% of your balance, or $100, and a minimum monthly payment of $10 thereafter. If you continued to make only the minimum monthly payments after that, as they gradually decreased, it would take you 89 months. That's more than 7 years, and cost more than $800 in interest to pay off that $2,000. But your installment loan would charge you $100 every month, and you would pay off the entire balance in 24 months, for a total interest cost of only $394. Of course, these examples are hypothetical and for illustrative purposes only. Your actual results may vary. The way to pay off debt on a credit card is to treat it like a loan. In other words, pay a fixed amount every month. A little later on, we'll get into more detail on exactly how to do this. The average credit card debt in the United States is about $15,112 per household. Using Worksheet 2, we can calculate a debt-to-income ratio to get an idea of where you stand. First, tally all the payments you make each month to credit card companies and other creditors. Exclude mortgage at this point. Divide that figure by the amount of money you take home after taxes each month. If you multiply that result by 100, you'll get a percentage figure for the ratio of your debt to your income. So where do you stand? As a general rule, if your debt-to-income ratio is less than 15%, you may be in good shape. Anything more than 20% could indicate trouble. Next, let's see if you're overextended. Do any of these scenarios on Worksheet 2 apply to you? Even one may indicate a potential problem. So how do you start to dig out from under this debt? Start by finding out where your money goes each month. Take a few minutes to write down all your typical expenses for 1 month on Worksheet 3. Use the categories listed and add your own, but make sure you fit all your expenditures somewhere. Total your expenditures and write down your monthly salary after taxes. In other words, the amount you actually take home, for comparison. Are you spending more than you take in? If so, you'll need to identify where you're overspending. Take a closer look at each category. Where's most of your income going? Is the dining out category more than groceries? Is entertainment a big chunk? You may need to cut back or compensate by trimming somewhere else. Because what we've just done is based mostly on estimates, you probably have a good but imperfect picture of your money outflow. Throughout the next month, keep track of your expenditures on a daily basis and then update this worksheet. At the end of each day, write down any purchases you made, either in cash, by check, debit, or credit card. Be sure to include all bills as well. Total up your outlay and compare it with your monthly income. Can you decrease your spending in other categories to allow for more to go toward debt payments? Let's find out by creating a monthly budget in which you designate a set dollar amount for each category, including debt and savings. As you get a more precise picture of your monthly spending, you can modify the plan to fit your needs. You should create savings by budgeting for it each month. Financial professionals recommend saving 10% of your income each month. Building savings is key to reducing debt because you'll have money to fall back on in emergencies, avoiding the use of credit cards. Using Worksheet 4, create a budget for 1 month. Remember that although a review of old spending habits can help you determine realistic figures, your budget should be a guide for allocating your income wisely. With the information from 1 month, create a draft 12-month spending plan with Worksheet 5. Be sure to include your new savings and debt reduction figures. You'll want to include all sources of income and all fixed and variable expenses. When you go home, you can use last year's pay stubs, checkbook register, and credit card and bank statements to help you fine-tune your plan. You'll notice that the worksheet contains blanks for both planned and actual expenditures each month. This comparison allows you to see how well you follow your budget. It does little good to make a budget you can't stick with, so be realistic and remember, the plan is a draft. You may need to modify your strategy to accommodate changes in your situation. Paying off your debt is one of the best investments you can make, and it's entirely risk-free. If you have savings in a bank account, for example, consider using some of that money to pay down your debt. Why give up part of your savings? Because you actually save more over the long term by getting rid of those interest payments. Let's look at an example of how this works. Let's look at 2 scenarios. First, say you owe $1,000 on a credit card charging you 18% interest annually. Meanwhile, you have $1,000 in net assets, not including your 3 months of living expenses, sitting in your bank account, which is paying 1.25%. At the end of the year, you would have paid out $180 in interest on your credit card balance and earned $12.50 in interest on your bank savings account, resulting in a loss for the year of $167.50. But if you'd taken your savings and used them to pay off your credit card debt, you would have broken even, a much better result. Another option might be to take out a low-interest loan to pay off your debt. If you have substantial equity in your home, a home equity loan may be especially appealing because the interest paid is generally tax deductible. A tax advisor can help you determine if this may be appropriate for your situation. If you don't have a lump sum of savings to pay off your debt all at once, you can still save on interest payments if you gradually decrease your credit card or loan balances by paying more than the minimum payment. You can gradually pay off all your debt this way. From your monthly budget, designate a set amount to pay each month on each balance you carry. Allocate the highest payment to the card or loan with the highest interest rate. As each balance is paid off, add those payments to the next card or loan until all are paid off. Set up a realistic payment schedule and stick with it. If you need to, readjust your schedule. It's better to set yourself back a little than to give up entirely. Using Worksheet 6, you can estimate how long it will take to pay off each debt, given your current payments. Then, for comparison, run through the calculation a second time, using the new payment amount you budgeted. Remember that the longer you retain a balance, the more total interest you'll pay. Once you reduce your debt burden, take steps to prevent it from returning. Limit your use of credit cards. By carrying 1, 2 at the most, you can lower the temptation to charge. If you put all your purchases on one card, you'll have one statement. It'll be easier to track your spending. Use the second one for emergencies only. Cancel credit cards that charge a higher interest rate. Leave your cards at home unless you really need them. Let's look at 2 scenarios. First, say you owe $1,000 on a credit card charging you 18% interest annually. Meanwhile, you have $1,000 in net assets, not including your 3 months of living expenses, sitting in your bank account, which is paying 1.25%. At the end of the year, you would have paid out $180 in interest on your credit card balance and earned $12.50 in interest on your bank savings account, resulting in a loss for the year of $167.50. But if you'd taken your savings and used them to pay off your credit card debt, you would have broken even, a much better result. Another option might be to take out a low-interest loan to pay off your debt. If you have substantial equity in your home, a home equity loan may be especially appealing because the interest paid is generally tax-deductible. A tax advisor can help you determine if this may be appropriate for your situation. If you don't have a lump sum of savings to pay off your debt all at once, you can still save on interest payments if you gradually decrease your credit card or loan balances by paying more than the minimum payment. Today, you've likely identified a need to modify your spending behavior. Following these basic guidelines may help. Think about purchases before you make them. Think of needs and priorities. Can you explain why you need to make the purchase? If not, don't make it. Use cash or debit cards whenever possible, even if it's just for partial payment. Charge the rest only if necessary. There are other ways to save too. Examine insurance policies for potential savings. You can raise deductibles and eliminate unnecessary insurance policies. Determine if any assets can be sold, especially items that you're making payments on but not using very much, such as a boat, snowmobile, etc. It might sound obvious, but be conservative in your use of utilities, electricity, gas, and phone. Try cutting down on pleasure spending, shopping trips, eating out. Buy in bulk at discount stores. Use coupons. Buy generic goods. Make a list before you shop and stick to it. That brings us to the conclusion of today's workshop. I want to thank you all for joining me. There's one final point I'd like to make. Regardless of your experience level with investing, you could no doubt benefit from consulting with a financial investment planning professional. The information presented here today is a broad overview of what's involved in the investing process. A professional can help ensure that your investment decisions make sense for your particular situation.